Hi, my name's Dave Seymour. Welcome, Freedom Venture Investments. Very excited to have a very good friend of mine on the call today. And I mean that sincerely. There are certain tools that wealthy people have in their toolbox that the average person doesn't have. And we're going to talk about that today. I have on the call with me and on this recorded Zoom call that we all seem to live on, my very dear friend, Greg Helene. He's out in California this morning. He is the co-founder and owner of Horizon Trust. So if you could turn on your video there, buddy. Let's see if this thing.
All right, there we are.
There you go, brother. How are you, man?
Good. How you doing? Thanks for having me, Dave.
Yeah, no, I'm doing well, man. It's a crazy time in real estate, crazy time in our country for sure. But out of chaos comes opportunity. So give the folks who are watching this a little breakdown of who you are, how you got started in real estate, brother, and what's your wheelhouse today? What are you spending your time on? Let's start there.
Well, and let me excuse any background noise because it is an interesting time. So I do have the kiddos at home and family life, so there's a little background noise. This is real, right? This is not taped over and shot a few times in a row. But so let me just start with, look, self-directing is typically a subject that is kind of boring, frankly, unless you understand it. And I've just grown a passion for it because it really built my career and my excitement really in the real estate world. So let me just back up real quick and explain. Self-directing IRA, a self-directed retirement account, is frankly just it's not a technical term. It's just it's used as it was actually approved. This self-directing vehicle was approved in 1974. So it's been around for over 40 years. Most people don't know about it. We'll talk about why. But it's been around for a really long time. And all it is basically a vehicle in which the IRS has approved individuals to use the retirement plans to invest in what they want. Now, what they want, which is the important part. And the second part of that, which actually catapulted my career, is if you don't have an IRA or retirement account, you can actually learn how to use other people's retirement accounts, meaning they might lend you their funds. And so I've learned both sides of it. Now I'm more on the passive side of the retirement accounts, where I do a lot of my own investing in alternative assets like real estate. But a self-directed vehicle is basically a vehicle which the IRS has approved to allow individuals to invest in what they want. And so I've been doing that for, I actually was in the real estate game for a long time. That was 19 years ago. I started in real estate, and I started the trust company business about 12 years ago. And I started it primarily only because I was looking for a company that would help me fund my real estate deals using IRAs. And the companies at that time, I just felt like their service was terrible. And because they were slow and they didn't understand it very well, it actually slowed down my deals, and I lost deals because of it. So that's actually how I got into the industry. And now it's primarily what I do. I probably do 3 to 5 different real estate deals a year. I used to do like 30 to 40 a year. I do 3 to 5. And now I focus primarily on teaching people how to use the retirement accounts.
That was it's always a fire hose with you, man.
Sorry, was that too much? I wanted to jump right into it, so I'll slow down. And Dave, I get excited about this subject, so go ahead.
I do, man. It's like I'm like, whoa! I'm doing one of these in the background. Let me pull a. I love you, brother. I do. I've always loved you. I've loved your energy. I love what you've done for me and my business. Let's go back a little bit. First of all, you said self-directed IRAs, individual retirement accounts, right? Our retirements, our 401ks, our IRAs, et cetera, et cetera. You said the ability to self-direct them was actually approved in the 70s. Is that what you said?
Correct. In the 70s is when the IRS approved individuals to self-direct, meaning move their funds into kind of whatever they want, with a few exceptions.
So hold on a second. So if my math is right, that's almost 50 years ago. Is that correct?
That's right. Like 46. Yeah. 46, 47. There you go.
We'll round it up. So let me ask you a question. I know for a fact that there is a large majority of people who watch this recording have no idea that they even existed. Why?
Well, There's two there. Well, the main reason why most people don't know about this is kind of an obvious one if you think about it for a minute. If you self-direct your funds, that means you're moving your money from where it may be. Now, where will it be typically? A broker. So Charles Schwab, Fidelity, Merrill Lynch, you name it. The big houses, Fidelity. That means you're moving your money from them to a trust company like mine, Horizon Trust. And then what happens is they no longer get a fee. So your financial advisor is not going to advise you and say, hey, if you want to move part of your money away from me so I don't make a fee, feel free to move it here. And so that's the number one reason why you probably will never hear about it. But the other reason why I think you might not hear about it is it's not for everybody. You might just kind of hear about it in general, and this it's not the right approach for everybody. If you can't kind of pay attention a little bit to your retirement plan and accounts, then it might not be for you.
So look, so it might not be for me. Then why would an investor even want to deal with one of these things? I mean, what's the advantage in it, and what's the disadvantage? Because that's a pretty powerful statement. This may not be for you. I mean, we're in the financial industry in essence, right? I raise a fund and deploy capital. You create vehicles where people can move capital. I mean, why would an investor even want one of these things, Greg?
Well, what my quick answer to that is how. Who do you think cares most about your money? Do you think it's me? Do you think it's you, Dave? Do you think it's your financial advisor? No, I assure you it's not. I mean, when's the last time your financial advisor called you and was like, hey, Dave, I got this great stock tip or this great mutual, whatever the case is, send me over $10,000 or $100,000. I actually wish they would do that. They don't. The only time they call you is when they're like, hey, do you want to increase your contributions? Why do they want you to increase your contributions? Because the more you got invested, the larger their fee is every year. So that's one reason. The second reason is I really enjoy making more than the typical what the market makes. Meaning if you can self-direct and invest in something you actually understand and make an extra 2, 3, 4% per year on your money, what that does over 10, 20, or 30-year period, we're talking about hundreds of thousands, if not $1 million difference, just by making a few percentage points more. And so that's why one should do this.
I had a guy, and I love what you just said because it's absolutely to the point. Look, man, you know me, you know where I came from. I didn't come from a financial background. I'm a blue collar guy in a white collar world, and I kind of bring that attitude with me. But I remember the first time a gentleman explained to me what a compounding cost does to compounding returns. And we don't have to go too far into that. But for every time that I have a consistent cost inside a growth vehicle, I end up diminishing those returns substantially, to your point, over the longevity of the capital going to work. And nobody teaches that. I mean, nobody is out there sharing that information because it would be a deficit to, like you said, to the financial industry's messaging, if we'll say, that the story that they tell that most folks participate in. So talking about participation, let's try this one. Who is and who is not eligible for self-directed retirement accounts? Because it can be kind of scary to think, okay, now I got the responsibility of making it grow. So who is and who isn't, or is everybody eligible?
In general, everybody's eligible, but let me explain further, because I say everyone because one could actually open up an IRA account from scratch and put in $5,500 or $6,500 or more and start from scratch. So that's why in general everybody is, but realistically our demographic, our kind of client is one that has typically over 25,000 or more in a retirement account, meaning a SEP IRA, a simple IRA, a Roth IRA, or a traditional IRA. The last bucket that I like to explain is those also that are available or eligible have a 401k from a prior employer. So that means if you're currently employed with the company and you have a 401k that you contribute to, that's eligible to move over. But again, in today's world, right, with pandemic and everyone changing jobs or whatever the case may be, a lot of individuals, probably at least a third of those listening to this call, have an old 401k they're not really paying attention to. Those are eligible to self-direct. So we get a lot of those, and we also get a lot of just IRAs, people that have an IRA that's existing that are just kind of sick of the same old returns, that are not really paying attention and not understanding what they invest in, and they'd rather invest in real estate or something they understand better. So that's who's eligible for typically, in our demographic for self-directing.
Now, when I took my capital that I had left from the fire department, I put it into a self-directed vehicle. And I think it's important for folks to understand this, and I'll share from my own experience. I was told that I could invest in anything that I understood. And what I mean by that was other people's businesses. If I still understood the stock market and I wanted to be my own day trader, I could choose to do that. Obviously, for me, I put it in sticks and bricks. I was also told that I could be a lender to other investors. Where do you see the majority of your clients directing their investments? What's the big business right now for that you see?
Well, look, I'm a little bit biased because my roots are real estate. And I also think that's why people typically that invest in any kind of real estate work with our boutique kind of trust company, because we understand it. Right? That was the basis of the foundational basis of our company. So, 70% I would say of our clients invest in some kind of real estate, be it wholesaling or lending or flipping or whatever the case may be, or even businesses and LLCs that buy real estate. So that's where I see most of it, but it's also because that's what we know really, really well. I will say that, again, it's, this isn't because I'm biased, but there's been more millionaires made in this country because of real estate than any other industry. So I think that's also why people typically invest in real estate, and they understand it, right? I mean, people understand real estate better than typically a mutual fund. Mutual fund is a little bit confusing, and there's 6 different people getting fees on it, and somehow it's supposed to go up, but it goes down. And so real estate, like you said, sticks and bricks, even when the market goes down, at least you still own a piece of property. Typically, it depends on kind of what you're investing in with your self-directed IRA. I will say, you didn't ask, but I'm going to jump to it. What you can't invest in real estate is like your own home. You can't move your money into self-directed and purchase your own home.
Can I pay my kids out of my self-directed retirement account?
Your kids, you can't be. There is a few rules, but for the most part, almost everything's fair game. And we explain that to you when we do a one-on-one consultation with my staff, and when we kind of figure out what you're trying to accomplish. But you can invest. You can lend to your business partner and vice versa. You can't buy your own home or a vacation property. That would be taxable. That means now you're using your retirement funds before the age of 59 and a half. So, yeah.
Oh, look, man, I know it obviously firsthand, but I've seen that self-direction through real estate has been an absolute accelerator for me, right? An accelerator. I would say to anybody watching this, have you ever looked at your 401k account and wonder why it's not growing when it says on the statement it's a 7% return, right? The dollars and cents don't always correlate. My question to you is this. All right, we covered self-directed IRAs, individual retirement accounts, but one of the sexiest vehicles that I hear a lot about out there right now is what's called a solo 401k. Can you give me the bullet points on one of those, Greg, and what that looks like, and why is that maybe better than a self-directed or not better than a self-directed IRA?
Well, we open and hold people's solo Ks or 401k accounts at Horizon. We do individual 401ks. We don't really do big company 401ks. I'll start with this, saying that when we do a one-on-one call with you, we're going to find out what your goals are and what your intentions are, and how much you can put away, and see, what if you qualify for it. But a lot of people who are getting into the self-directed space, who will maybe start their own business with an LLC, will also open up an individual 401k. And the advantage of that, and to answer your question here now, there's a few things that make it attractive, but I'll just focus on 2 of them really. First and foremost, you can contribute a lot more. So typically in your IRA, you can only contribute $5,500 or $6,500. In a solo K, you can put up to $52,000. I mean, that's a huge difference. So for those of you that are kind of behind on your savings and preparing for retirement, you can put up a lot more. So that's number one.
And is that tax-free, Greg, going in, that 50-52? That's a tax-free contribution into a solo 401k?
So a solo 401k there's different kinds of accounts we can set up inside of your solo K. So if you set up a traditional 401k, yes, that would be a deduction on your tax return. You know, it'd be 50,000 less that you pay tax on. What I would say, if you're 50 or younger, or 55 maybe, I mean, it depends on what you plan on doing. It could be, you can actually go up to 65 or younger probably. But for those of you that are planning on making really big returns in your 401k, you can actually set up a 401k with a Roth bucket. So it's like a Roth 401k, which is actually what I have. So you don't get the tax write-off now, right? Because it's after-tax dollars.
Distribution.
But every dollar that goes, you don't pay any gains, any tax on your gains, and it all comes out tax-free. So if you plan on only maybe investing for 5 or 10 years with it, probably just do your traditional. But if you think you'll be investing it for 10 years or more, you should absolutely do a Roth bucket. It's really creative, and it's been approved. It's funny. These are kind of little, things that you never hear about, or really it's the really, really maybe educated or lobbyists that understand this and play with it. But we're pretty good at it. I'd say we open about 100 a month of these kind of accounts. And so we know how to do it. But anyways, that's number one. And the number two benefit from a 401k rather than just a traditional self-directed IRA is you can borrow from it. So you can borrow 50% or up to $50,000, whichever is lesser. So if you have like a $50,000 account, you can borrow up to $25,000, and you can use that money for whatever you want, anything. I don't recommend it. You can use it for vacation, but that's not what it's typically. You pay off, debts or something that's kind of have high interest. And what's cool about that is when you borrow it, you do have to pay it back over 5 years, and it's prime plus 1 or 2. But that interest rate, let's just say you're paying 4% interest rate back in the loan back to your retirement account. That 4% you're paying yourself back. So
instead of somebody else.
So
yeah.
It's kind of like a free loan, more or less. But you want to get it paid back as quick as possible because you want to keep the compounding going. But those are the two main advantages of having a solo K, and we have a lot of people that do that.
I tell you, man, I already know a lot of this stuff. I don't live and breathe it every single day like you do. But even after all these years in the business, I still get excited. I get excited when I talk to you, man. It's like, I'm going to have a good day today. Look at the size of the smile on my face.
I love it. Well, that's the goal, because it's it's such a tough subject, because taxes and IRS things typically people fall asleep on, but it's exciting because there's so many loopholes where you can actually make some big gains.
Yeah. You know what's funny? I was told one time the consumer mindset calls it a loophole. We as entrepreneurs, we actually refer to it behind closed doors as tax advantages and opportunity.
Yes,
you know what I mean?
I agree.
They're all, you know what I mean? They're all right there. They were written by the 1%, so why shouldn't we participate in it? You know what I mean? All right, let's go to the dark side. This has got to be expensive, man. You must charge an arm and a leg for all of this stuff, no?
No. I like the way you tee me up. Like it's supposed to be expensive. No, that's the look. You don't hear about these things because of what I said previously. It's just we can't. Our company can't compete with marketing against Fidelity. I mean, these guys, these giants. That's who you see on TV every day.
Yeah.
But no, look. Typically, just to give you an idea, most people in the retirement accounts are paying anywhere from 1 to 3 or 4% per year. You might not think it. Everyone tells me, "Oh, no, I pay 1%. Here it is." But you actually are missing the loads and different fees that are inside your mutual funds that aren't on your statement. So I'll start with that. You're paying between 1 and 3. And our fees range from 50 basis points to 75 basis points. What does that mean? It's a half a point to 3/4 of a point. So it's less than 1%. In our 401ks, it's less than $1,000 per year. It's around $600 to $700 per year. So I mean that's a flat fee on our solo Ks. And so you do the math. If you got 100,000 or more, it's less than 1%. So not only are there fees, even if we were more, and we're not, but even if we were more, then typically people in their self-directed accounts should be making between 2 and 4% more per year, if not even more than that.
No, agreed.
So the fee is really a non-issue.
So as you know, we're raising capital right now for our private equity fund. You've been a resource for me personally and you know, my clients over the years. If one of my clients, and like I was talking to a guy this morning setting up a solo 401k, I think he's already coming your way. But when a client comes from us through to your services and they say, yeah, you know, I want to set up a self-directed vehicle, whether it be an IRA or a solo 401k, what does that onboarding experience look like, and what's the investment that my clients would be making if they're coming from me to you?
So you know, again, this is mostly for education reasons. Anyways, obviously, we'd love to earn your business. If you go elsewhere, you'll end up probably back to us because I feel I'm so confident in our service. Because that's the only difference. There's a handful of trust companies. We all do the same thing. We're licensed to do the same thing. The only difference truly is customer service and how quickly we move money, and that's actually super critical. So we move money, I would say, at least half the time that every other company does. And what does that mean? It means that extra 2 to 4 weeks quicker that we do is 2 to 4 weeks of interest that you're making where you want to be putting your money. And so, look, the process is pretty simple. We handle 90% of the work for you. We recommend a one-on-one call with our team. Most companies say just go to our website, print out the forms, fill it out. Sometimes they're a little bit cumbersome and not understanding which boxes to check. We do a 15 to 20 minute phone call one time over the phone, help you fill it out. And then you can sign it and send it to us, or just submit it to us. And then once we get your paperwork, we request the funds to be transferred, all or part of it. That's the other thing that's important is if you decide to self-direct, this is not an all or nothing thing. Like, okay, I'm going to move all of my retirement funds into this, into this self-directed vehicle. You can, if you got, let's say $100,000 at Charles Schwab, you can leave 50,000 there and move 50,000 to a self-directed IRA. So you can have both things and kind of test it out for a little while. In fact, I recommend that. See if this idea is actually better than the market. And then you can move more money over the following year. And so it's pretty simple. It takes us a couple weeks to move your money over. Believe it or not, it typically takes most companies 4 to 8 weeks to move money over. So that's where we're just better. But yeah, that's the process.
Beautiful. Well, look, man, I love it. You know, I love it. I've always loved it. I've always enjoyed, having you being part of the dream team. So the way it'll work is this: is anybody that's coming through Freedom Venture Investments, I'll tell you what we'll do. We'll have our technical guys, the ones that are smarter than us, find some way of linking up through our websites. And then we'll service our clients going forward, man. So
let me add to that, Dave, just real quick. Sorry, interrupt you. Look, if you come through and contact Dave, and I'm sure you'll figure out the link, etc. Like you said,
yeah.
we will waive your setup fee. And so typically there's a one-time setup fee that's a few $100s, and then just our normal annual fee. If you come through Dave and then the link that he's got here somewhere below,
somewhere,
we will waive your setup fee. And so just look, we want to have you have a good experience and really start making more money than you are right now.
Brother, thank you, man. I appreciate you. Thanks for being there. Thanks for the the service you give our clients and also other people as well, showing them how to build a little wealth through some self-direction. All right, man. Thank you. I appreciate you, brother. Be well.
Thanks, Dave.
Take care.